So I'm Steve Squires. Some of you might know me. It's nice to see some familiar faces on this call. I run the event Freelance Facebook group on Facebook, and also the freelance community platform Connektd, which is a platform specifically for freelancers who work in the events industry, who I believe most of these people on this call are. We've set up some partnerships with companies supplying useful services to freelancers, and this includes Mazuma Money and Create Insurance. And today we've got Lucy Cohen from Mazuma Money, who's going to talk about the various different schemes that have been launched by the government to support various people during the coronavirus crisis, but also just some general tips and information about being a freelancer and running a business. What's become clear over the last couple of months really is that there's a gap in knowledge really about what it means to run a business as a freelancer sometimes, and the difference between being self-employed and employed by a limited company. And also there's an awful lot of opinion out there. So we figured it would be a really good idea to actually get someone who is an accountant to firstly give some information, but then also answer your questions as well. So what we'll do is Lucy's probably going to talk for about 25 minutes, half an hour. During that time, if you've got questions, just put them in the chat, and we'll keep a track of them, and then we'll have probably about half an hour at the end to answer those questions. We do have another one of these. This is the first in a series, and we've got another one in 2 weeks with Create Insurance, who I know are on this call as well. So I'm going to hand over to Lucy, and as I say, any questions you've got at any time during this session, just add them to the chat, and we'll come to them later. Over to you, Lucy.
Hi. Okay. Afternoon, everybody. In day 500 or whatever we're on now of lockdown. I hope that you are all hanging in there. I just wanted to go over, as Steve mentioned today, some things that have really cropped up in terms of the support and who's eligible for it and what they're eligible for and how easy it is to access from the government. The government moved really quickly in terms of announcing a lot of the support that is going to be available, but in terms of when it actually became available, that kind of rolled out more slowly. And if you've been self-employed, or you're the director of a limited company, or you're freelance via an owner-managed limited company, you'll know that that support not only has been slow in terms of the information getting out there about what's available, applying for it is tricky, multifaceted, and there's lots of different things you've got to be doing. And whether it's applicable to you or not has been confusing, especially around limited companies. So kicking off then, the first thing that got announced was the coronavirus job retention scheme, alongside the coronavirus business interruption loans. They kind of came hand in hand in that big announcement from Rishi Sunak. And we've spent, as a firm, the last few weeks processing the job retention scheme claims. They're not perfect. It was the right move for the government to do them. But they are tricky. They've left a lot of people fall outside the remit. The big question that came up, which I'm guessing is the one that applies to most of you on the call, is if you're running through a limited company, whether it was going to apply to directors of limited companies. Now, when it first got announced, this all kind of, the thinking behind it is when you're a director of a limited company, to kind of backtrack a little bit, a lot of people get set up that way by their accountants because it's more tax efficient, or it's better for insurance in terms of indemnity. And they'll get set up like that by their accountants, and they're not really questioning it. Their accountant does it for them. They take money in and out and in their bank account, and they don't really think about it. And someone files some stuff for them, and once a year maybe they pay a tax bill, and it's all kind of taken care of. And it's only when something like this happens, and this has never happened before, that you really have to look at how much do you actually know about your setup. You know, I was getting phone calls and emails and tweets from people going, "Oh, but I'm self-employed. I'm eligible for 80% when that got announced." I was like, no, you're not self-employed. You're a director of a limited company. They're two fundamentally different things. You might be, as a director of a limited company, You might consider yourself, for all intents and purposes, self-employed. It might be just you. You might be 100% responsible for the income you bring in. You do all the invoicing, you run the business, you run the website, you do all that kind of stuff. It's just you. But if you are a limited company, you are not self-employed. You are, if it's just you, is what we refer to as an owner-managed limited company. So the reason that's different is that there is a legal separation between you and your business. So when you're a sole trader and you're self-employed, it's just you, and there's no legal distinction between that. You don't legally have to have a separate business bank account. You're assessed not on what you take out of your business in terms of drawings, but on your net profit every year. And you, if someone's going to sue you, if there's a legal claim to be brought, it'll be brought against you personally and not any company. So it's just you. And the only reporting you have to do is for your tax return at the end of the year. If you're a limited company, you are simultaneously, if you're set up like most people are, as a director and an employee and a shareholder, you're simultaneously a director of that limited company, in that you have the statutory obligations and you are legally responsible for filing and looking after all the reporting of that company, as well as making sure that it's run legally. You are a shareholder in that company, which is the same as being a shareholder in any other company. The board can nominate to pay out dividends as often as they like, with all the associated kind of paperwork and dividend vouchers, and you happen to be a shareholder of it. The fact you own the company in terms of it's the fact you're a director of the company in terms of a statutory sense, it actually doesn't really bear any relevance legally to the fact you're a shareholder as well. You've just made a good investment in your own company. And then also you're probably an employee, and that's the payroll. So when the coronavirus job retention scheme got announced, straight away I knew that it wasn't going to be 80% of income or profits for limited companies, because you're not receiving, most of you who are running through limited companies are not receiving your money in the same way that a sole trader would or an employee would. You're taking a small salary and probably topping that up with dividends. And that meant that you were not eligible. Dividends are still not covered because it's investment income. It's i.e. you could buy shares in, I know, Tesco, say, other supermarkets are available, and you have shares in Tesco and they might give you a massive payout in terms of the dividend that year. Well, if they included, from a legal basis, if they were to include dividends in what would be assessed under your income for the COVID-19 support, those dividends would equally count towards income. So dividends as a legal ring-fenced item are excluded from that support, which sucks if you're a limited company director and it's just you, because the only thing that you can claim in terms of grant aid during this crisis is the job retention scheme, and a lot of people take a very small salary. So you're claiming 80% of a very small salary. Now, granted, it's better than nothing, but if all of your work has dried up, that's not great either. There was initially a legal challenge around that, in that, strictly speaking, can a director of a company, if the company still exists, ever really be furloughed? Because you are still legally responsible for the admin. You're still accessing the bank account, potentially you still may be paying people even though you've got no money coming in. You're still filing accounts or doing admin work. So strictly speaking, you're actually working. Are you furloughed? So there were some legal challenges raised, and eventually the government acquiesced and said, yes, you can be furloughed, and you can, you're still doing administrative duties for your company, but you're not bringing in the main amount of work. So that's an interesting one, and that's left a lot of freelancers or people who run through limited companies a little bit kind of wavering in terms of what they can do. You can, of course, it was initially at that time announced, you can apply for a coronavirus business interruption loan. From personal experience with these loans, they are not great. They are very tricky to get. The lending criteria has been massively dependent upon who the bank is that you go to and your relationship with them. They've been incredibly difficult, and I've seen people from our own client base taking up to 6 weeks now to get money from the CBIL scheme, so not brilliant. The bounce back loans have been much swifter in terms of availability, up to 50k, get the money almost instantaneously. A lot of the challenger banks have done a great job of getting that money out to people. So if that's something you look at, obviously it's not a grant, it's a loan, you've got to pay it back, but you can use that money to get you through that period, which is better than nothing. And if there's no repayments for the first year and no interest repayments for the first year, no penalties for paying it back in full or early, then it's a good cash buffer for now. If you're self-employed and a sole trader, so not through a limited company now, the government announced, I think it was a week or 10 days after the first announcement, about the support for self-employed people. Another interesting one. Again, it was what I predicted. I said they go 80% of average net profits over 3 years, because that 3-year thing tends to be what all kind of borrowing. And if you've ever applied for mortgage as a self-employed person, they usually want 3 years worth of accounts, loans, same. So I was kind of 3 years is usually what they do. But again, it's a controversial one, because if you started a business 3 years ago, your first year you might have made a loss, and then you might have had 2 kind of better years, well, you might have just been on an upward trajectory, and suddenly this hits and you're back to zero. Maybe in that time, you've moved house, you've taken more expenses. Is it fair to tell somebody, or you can have your 80% of your net profits based on partly what you used to earn 3 years ago? I don't know. Is it the best solution, the way of doing it, or the easiest way of doing it? Probably, because HMRC already have all that data. They can pull your tax return information quite easily. And actually the system for applying for it is quite simple. It's not something accountants could do for you, unlike the job retention scheme stuff. You have to go and do that yourself. But it's actually very quick, and we've seen people receiving that money into their bank accounts in as little as 4 days. So that's been a bit of a lifesaver for people. But interestingly, there's no news of this being extended. So the coronavirus job retention scheme, it was announced, has been extended to the end of October, and remains as it is until the end of July. And then after that, we're still hazy on details, we've not been told, but that employers will have to contribute to the 80% if they've still got people on furlough. So that's an interesting one. There's been no talk and no mention, and I'm sceptical if it's going to appear, of any additional support past this one individual grant payment for sole traders and self-employed people. That grant payment covers March, April and May. And initially they said you can apply for it in June, but obviously the portal opened early, and there's been absolutely no talk of it being extended further. Now this is going to cause problems, especially given the devolved nature of the country. I live in Wales. We are in a completely different lockdown situation to England. So if you're a sole trader in England, potentially you might be able to go back to work relatively soon. In Wales, that lockdown might have extended, and obviously at the moment all this support is very centralised, so I don't know whether there's going to be some kind of devolution issues in terms of that. But in a nutshell, that's really the support that's out there. There's a lot of flurry, a lot of questions, a lot of ifs and buts when it all went out, but it's ultimately, I think the people who mentioned as well, the people who've really struggled with this are those that have only just become self-employed or just set up as a limited company, because there really isn't any support for you at all. If you started your self-employed journey after the 6th of April 2019, there's no support for you. So you might have been self-employed for an entire year. You could have worked your socks off to say, you burned through your savings in your first year of self-employment. I remember that, I did it. And suddenly the world's on stop and you can't actually earn any money. But not only that, there's no support available for you apart from tax credits, universal credit. So that's been tricky. Now, a note on universal credit, always worth looking at. A few people have kind of said, I should look at it and all the rest of it, and it won't be applicable for me. They have extended some of the criteria in terms of who can apply for it and what the upper and lower limits of it are. So do look at that. Likewise, I would say bounce back loans are a great idea, especially if you're a self-employed person who's got profits over 50k. That is very much a cliff edge scenario. If you earned £50,010 profit in a year, you suddenly are not eligible for support as a self-employed person under the SE an SEIIS scheme. I think I got that one right. There's a lot of acronyms at the moment. Yeah, so it's an interesting one, and I think the real things it's highlighting, I'm hoping I can see some questions popping up on the right hand side of my screen. I'm hoping that what this has done actually has made people start to question the advice they're given and start to look at, well, someone advised me to set up this, why? What does it actually mean? Rather than kind of, it's so easy to incorporate a limited company. You can do it in a second online. It costs barely anything, but the penalties and the difficulties in running a limited company, if you don't know what's involved in it, are actually quite substantial. You know, late filing penalties, left, right, centre. Not to mention, obviously, the fact that you're legally speaking responsible for it. I've never actually known anyone in a small business prosecuted under the Companies Act, but potentially it could happen. It is something else that kind of a burden that is on your shoulders as a company director. And I think there's a lot of people out there who have always considered themselves self-employed. I've heard people, we do a lot of work with people in the film and TV industry. They've been running through owner-managed limited companies for years, decades even, and they still refer to themselves as Schedule D, which is old school language for being a self-employed person, which is completely wrong. So I think that there's a real opportunity here as business owners and freelancers and self-employed people to understand the legal setup of your business and what that means for you in terms of your ability to access support, your ability to access finance. It's a conversation we often have with clients who don't want to have a too large a profit. I was trying to say this in as tactical way as possible. But they want to make sure that they're being as tax efficient as possible. And it's always worth pointing out, well, if you've got really low profits for 3 years, your borrowing potential in terms of mortgages is limited. This is a really good example of when that's really kicked in. If you've been demonstrating low profits for 3 years as a sole trader, you're suddenly not going to be eligible for an awful lot of support. It's a contentious issue. There's a lot of people sitting around who don't understand the plight and the difficulties of being a self-employed person, and the administrative burden and the emotional burden of it, who sat around going, well, if you didn't claim profits for 3 years because you deflated them artificially, well, that's your own fault. I've heard that quite a lot. It's a lot of kind of profit shaming, if you like, as a term. And then you've got people who are saying, well, you've had it easy, you paid less tax than everybody for years, why should you get any help? And is it a valid question? I think it doesn't take into account the additional burden that self-employed people really have when you go self-employed or when you run a limited company, or have people in your books. Just have a quick look over at the questions. Steve, did you have any questions you wanted to
yeah, I think we've got some questions here, and I think
okay.
a lot of people have been sending questions to you directly. So maybe while I'll ask you a couple of questions, but maybe you might want to read off some of yours as well. Mm-hmm. So we've had a question from Deborah. With Universal Credit, have they changed the parameters for application? Can you have savings now?
They have changed the parameters, and they've changed a couple of times actually. There've been a few revisions, so it's worth double checking. So I know the parameters in terms of what you have saved, what is eligible in terms of the amount of money you're going to get back for them. They have changed. It's not like it was pre-COVID, so it's always worth checking, just in case. I can't off the top of my head remember the savings limits, but yeah, I know that we've had clients who previously were ineligible who have become eligible since COVID, even if they've got an amount of savings. So it is always worth looking. It's a hard one to comment on because some of them are based on what you're eligible for is based on who you live with, how much they earn, all this kind of you see is kind of a there's some weird algorithm that they kind of use to work it all out based on a load of factors. So it is worth looking at. It's also worth pointing out that if you were on Universal Credit and then received your job retention scheme money, or you received an SEIS grant, you can still remain on Universal Credit, but bear in mind that will now be treated as income, and so your UC amount that you're receiving might well reduce. So there's a lot of factors in play there. But yeah, I do think that they have revised some of the savings threshold, so it is worth double checking.
Okay, cool. We've got a question from Andy K. Can you give any explanation or any insight into the Chancellor's thinking re the 50,000 trading profits cap and where that came from?
Yeah, so obviously not a mind reader, but knowing how this kind of stuff works, 50k is the cap at which you stop being eligible for various other supports. So things like child benefit, for example. So if you, and that's higher earnings, not necessarily higher profits. Your higher earnings limit, if you earn over £50,000, you'll have to pay back any child benefit that you receive. So it's probably based around that 50k is the marker. Westminster have decided that if you made profit of 50k in the previous 3 years, you should probably have enough money and aren't eligible for support. And it is worth pointing out as well that support is capped. That 80% is capped at a maximum of £2,500 a month. So for self-employed people, that's £7,500 for that period. So even if you were kind of towards the top of that tree, that those two things kind of tie together. So that's where that comes from. It's odd. I think that it's a cliff edge scenario, that if you're just over, you become ineligible. But I think it's because that 50k figure seems to be where state support and other benefits stop as well. So it's probably neatly tying into that. Do I think it's fair? No, not necessarily. £50,000 profit if you're living in the centre of London and working your socks off is still not a huge amount of money. So I can't comment. I don't think it was necessarily fair, but I don't think a lot of things about the SEIS fair have been fair. You know, especially people who only just become self-employed, they've really been left in the lurch by this. So yeah, I'd say that's probably where that comes from, a double-edged thing of that's where other benefits stop, and also the thinking of, well, if you're earning 50k profit, then you probably don't need the support, which is potentially not true.
Okay, thanks. We've got a question from Penny Jekyll, which is something that's come up quite a few times actually, is people who've had advice from their accountants to take a sum of money at the end of every year in lieu of a salary, when obviously what the government's looking for is a monthly payroll. They've been advised to do that by their accountants. Do you think there's likely to be any change to that rule, which means that if you pay yourself annually that you're not entitled to job retention?
From what I've read, and I could be wrong, but from what I've read to date, as of today, I can't see there being any change to that rule. Basically, the rule was that you had to have had a payroll submission by the 19th of March on the RTI scheme. And if you hadn't made your annual payment then as a director, obviously if your year ends, say 31st of March, you may not have made that payment yet, you become ineligible for that support. Likewise, you've got people who have got... you don't even use the RTI scheme. So you've got people who are running through a limited company who aren't even making a submission in terms of an annual salary payroll. They're just putting an amount of payroll into their accounts at the end of the year that's below the threshold at which a PAYE scheme needs to be run. Those people, because they have no RTI submissions, will also be completely ineligible for any support, because according to the government records, you've never made any submissions under payroll, therefore you're ineligible for it. So yeah, so that furloughing does exclude people who hadn't made that annual payment via RTI. And again, from what I've heard, ear to the ground, I can't see that changing. They haven't even announced yet how or what the percentages are going to be in terms of employers supporting employers having to contribute to the furlough scheme after the end of July. We still don't even know what that is, which ultimately is what, 1 or 2 payrolls away from monthly employees. So yeah, I'd be surprised if it changed. I would make plans as if it's not going to.
Okay. And if anyone has been advised in the past that they should just pay themselves an amount at the end of the year and they don't need to run payroll, with making tax digital and the changes the government's making, is it something that people should be talking to their accountant about doing? Because it does seem to be a requirement that's becoming more essential. Yeah,
I mean, 100%. What I would say is this is a real situation where, you like I said at the top of this, is that you need to understand why you're set up the way you're set up. Why is your accountant doing these things the way they've said? You don't have to go into an in-depth understanding of it and know all the technical rules and regulations, but at least understand the pros and cons, because there are pros and cons to every setup. There's pros and cons to being limited. There's pros and cons to being a sole trader. And I think that it's really important that people kind of use this opportunity to take a little bit of ownership about understanding what goes on in their accounts and their taxes. This is a really good example of it. We always advise clients to do a monthly payroll. Firstly, you're making sure without any question or doubt that your NI is up to date and that you're on the system. And this is all about being on the system. Making tax digital, or it's been pushed again for a year because of COVID, for full adoption by everybody, people who aren't VAT registered. But making tax digital, the move is going to be that everyone is going to be reporting their income at least quarterly. So we're going to have a shift to a society and a shift in the accounts and tax world where the data that the HMRC has about you is going to be much more in real time. My prediction is that means that there's going to be more regular tax payments rather than kind of paying it once or twice a year. Whether they go down that way for corporation tax, I doubt they will for that, but they almost certainly will, I think, for income tax for sole traders. And I think that taking ownership of your figures and querying and going, why should I do this? And like I said, pros and cons, we'd always advise to do a monthly payroll for exactly this scenario. For if you needed to apply for any kind of support or state aid anyway, it's good to kind of have you on the system. And then also people do move accountants, and accountants tend to give different advice. Just having that monthly payroll does mean that at least if you're swapping between accountants or changing the amount of money that your company earns changes, at least you've got your kind of assurances that your national insurance is up to date, that you're declaring that you've got some income, because it also doesn't do you well in terms of tax investigation. So you have a tax investigation partway through a financial year and they're looking at your lifestyle and they're saying, oh, it's interesting you've got this lifestyle because you don't seem to have any payroll, you don't seem to earn all that much money. Just making sure that you're on the system means you're kind of going some way to answering those questions. Anecdotally, we did once have a client who claimed he couldn't pay his VAT bills. They're not a client anymore, and turned up to the appeal hearing in a Ferrari. So, don't do that. But make sure that you're on the system so that you're registered. And I think that there's a little bit historically in terms of disclosing to HMRC and kind of keeping up to date with stuff. People have been a bit wary of it. They do it at the last minute. They do it as late as possible. There's a little bit of, I don't want to know what I'm up to, which is fine. But let's just make sure you've got the basis covered in terms of declaring your income and making sure that you're eligible for state aid as and when it might be available. Likewise for making sure your national insurance is up to date, any nest pension schemes you've got running are up to date. You should be doing that through RTI and through at least monthly payroll files. If you've got an accountant or a piece of payroll software, it doesn't take long at all, and I really don't see a downside to it.
Can you just explain what is RTI? What does it stand for?
Sorry, yeah. So RTI is real-time information, and that was something that was introduced to the payroll system in 2014. People who've been freelance since prior to then will remember that you used to do one annual submission of your kind of year-end payroll. You P60s, and it was called P35. You used to submit all of that at the end of the year once, and then you'd have to pay, if you hadn't been keeping up to date with your PAYE and national insurance payments for your employees through the year, you'd have to pay it all in one lump. What that led to was loads of people defaulting on their PAYE and national insurance because it seemed not mandatory to pay it throughout the year, and then you got to the end of the year and realised you didn't have any cash. So to solve that problem, in 2014, HMRC introduced real-time information. And what that law means and what that rule means is that every time you pay yourself via payroll or anybody on your staff via payroll, you have to do a real-time information submission. So if you pay somebody monthly, you do one once a month. If you pay somebody weekly, you do a submission for them once a week. Again, it's something that crops up and people have been affected by this. We do, people who've had staff who they've had to furlough. We see staff who've been receiving their salaries weekly, but their employer, in order to save money on fees or time, whatever, has only been submitting once a month. But if their hours varied massively month to month and they didn't have that weekly submission up to the 19th of March, their furlough amounts have been affected as well. So that's another good reason to keep on top of it and keep it regular. As like Steve mentioned with making tax digital, the move in the industry and by government is going to be to get all this information more regularly from people. And you can guarantee after they've giving out a load of money to small businesses, they're going to be wanting to look at this a lot more closely and making sure they've got information from people on a much more regular basis. So whilst making tax digital might be deferred for a little bit, I think it's going to come, I think it's going to come in all guns blazing, because the government are going to want to start recouping this money that they've paid out.
Cool, thanks. I'll ask one more question, and then I know you've got some questions there as well. So I've got a question from Stuart about Early Day Motion 351, which is related to support for small limited companies.
Oh.
Do you have any knowledge of that?
I'm not on that one, I'm afraid. I could probably ask one of my team afterwards.
Okay, well, Stuart, if you want to drop me an email afterwards, I'll forward it on to Lucy, and then I'll put you in touch. Have you got some questions there?
I've seen one here from AJ. Is it true that all applications for loans and grants cannot be made by accountants? And does it matter that I'm not in the UK, but I'm a UK tax PAYE and resident? So if you've got a UK payroll, so you're running your payroll and submitting via RTI, like I said, in the UK, that, according to all the legislation I've read, that job retention scheme should apply because it's a UK payroll. In terms of the loan applications, it depends on the loans. Obviously, all of the loans require director guarantees, so or personal or signatures, if you like, not guarantees. They require to be signed off by the proprietor or the director, one of the directors of the company. If you're if you're a sole trader, you'll have to do that yourself. There are issues with data sharing if you're allowing accountants to make applications for you, and likewise being able to verify other aspects of income which accountants may not know that you have, especially if it's a new engagement or a new relationship. So those loans applications, I don't know whether they legally have to, but they definitely should be done. Obviously, you can have accountants help you in terms of the application, in terms of the preparation of figures, forecasts. I know the loans required forecasts, cash flow forecasts, and then for a lot of lenders, they wanted to see there's going to be some recovery afterwards, or things would return to normal once coronavirus has ended. So those forecasts, obviously you can get your accountant to help you prepare those, but the applications themselves will probably need to be done by the individual. Now, there are companies out there, there are brokers out there who work with accountants to place people with appropriate lenders. You can absolutely get your accountants to engage through those, and they'll signpost you in the right direction. But ultimately, that sign-off has to happen by the director or the proprietor, and so obviously that then will have to be done by you. It's a quirk of law in the UK in terms of accountancy, that even, or in fact any work, even if you delegate any legal or accountancy work out to a third party, you're still legally responsible for those returns that get filed. So even if someone else has prepared 100% of your returns and filed them for you, and you said, yeah, it's fine, sign it, it's fine, I trust you, get on with it, you're qualified, you can do this. If there's a problem with that return, it is you that will be brought up with. So it's worth remembering that in terms of all financial issues in the UK. Ultimately, the buck stops with you as the proprietor of your business. Even if it's not a defence in the UK to say, oh, well, my accountant did it, that it doesn't fly. Obviously, there are separate remedies. If your accountant's not done a great job, you can go through their association, or you can claim, you could try to sue them, and they could claim on their professional indemnity insurance, say. But actually, the buck does stop with you, and if you end up with fines or penalties because your accountant's done that, it's ultimately your fault. So likewise with loans, they should be signed off by you.
Okay.
I've seen a question here from Anne Morris. Can you claim for both the SEISS grant and the universal credit? Yes, you can. You can, but remember that if you were receiving the grant and you've already been claiming universal credit, the amount of universal credit you receive, depending on how much of a grant you get, can be affected by that. Likewise, if you're receiving, you've been furloughed by an employer, or you've had to furlough yourself, you can take other work and still make that furlough payment. You can go get a part-time job somewhere else if you needed to. It doesn't restrict you from doing that. It just means that the previous furloughing is covered. The only rule is you can't keep working in your own company and be furloughed simultaneously.
It seems like a perfect opportunity to ask a question which came up the other week, actually, about furlough. So if you if you've either been furloughed by a company or if you've furloughed yourself, you can only furlough yourself up to 3 weeks at a time. Is that right?
No, you can furlough yourself for longer, but each period, each period's for 3 weeks, so it can be extended a number of times.
Yeah, but it's for 3 weeks initially, isn't it? Because the question that came up
3 week minimum period,
was, can I furlough myself for 3 weeks and then work for the fourth and do all my invoicing and everything in the fourth week? Interested in your view on that one.
Strictly speaking, yes. This is a case of maybe legislation not catching up with people. Yeah, absolutely, strictly speaking can, because as a business that has employees in it that have been furloughed, what you could do, you can rotate who's on furlough. So you might have half, you might have reduced your capacity by 50%. So you might have half your staff on furlough and half not, and then rotate it every 3 weeks to keep it fair. So as a director of a limited company, if it's just your work realistically might have reduced from a full 4 weeks a month, so a full month's worth of work, down to 25% of it, which is only 1 week's worth. Well, you could absolutely do all that work in 1 week and then be furloughed the other 3. There isn't anything in the legislation that stops you doing that. However, what I would kind of give a warning on is I imagine they will be going back and checking some of these furlough claims, because I've heard anecdotally, and I've seen people on the internet talking about it, they've furloughed their staff and not told them they've furloughed they're claiming the furlough grant for their staff, they're not told their staff they're furloughed, and they're claiming it and the staff are still working. And obviously that's fraud, basically. So I imagine there will be a period, once this has settled down a bit, that they will be going back and checking through the furlough claims. You will have to prove that was the case, that you only had 1 week's worth of work. It was definitely in that week, and it didn't interrupt the 3 weeks that you were on furlough. It could all be done that way, and business need, business demand, all that kind of stuff. So you can do it technically, you absolutely can do it. However, I would buyer beware on this, because like I said, whilst I can't see anything in the legislation, I've been reading some other stuff, I can't see anything that says you can't do it. However, like I said, buyer beware. If they came back to you and said, oh, so how did that work then? You said you were a freelance graphic designer and your work was down to 25%. So what, you just did all that in 1 week and didn't do anything the rest of the time? You need to, if you're going to do that sort of thing, you need to think about, is it worth it? And how would I respond, and what would the justification be if this were to be questioned in the future? And also, as with a lot of these things, I've seen, I've been online a lot lately, there's nothing else to do. I've seen a lot of talk of people whose businesses haven't actually been detrimentally affected in terms of income by COVID-19, and they're still making a lot of money. When we say detrimentally affected, the definition of that in most cases in terms of CBILS is a reduction in your profits of about 40% or more, in your income of about 40% or more. They haven't been massively detrimentally affected by it, and I've seen them complaining that there's nothing that they can apply for. It doesn't apply to them. I'm like, well, good. It doesn't apply to you. That's a good thing that you're able to keep going. This support is supposed to be there for people who've overnight had their businesses closed down and are suddenly out of work and don't have any financial buffer zone to help them out. So whilst it is great that there is government support there, I'm also an advocate of thinking, just because it's there and I technically can take it, should I? That's a call for each and every individual person to make for themselves, but always look at this in terms of, if this got questioned one day, what would I say about it, and would it be legit, is my question. Okay,
cool, thank you. I've got one more question here, and then maybe we'll go to some more if you've got some more there. If you're now working from home 100%, and you are still now working, and you're not furloughed, but you're working from home, what can you claim, both as a sole trader and as a limited company, for working from home?
Sure. So working home expenses. People claim working from home. There's the basic allowance, which is off the top of my head, I want to say it's £4 a week or £6 a week. As an employee, I think you can claim from your employer £6 a week towards your working from home expenses. the key to the working at home thing, and that we tell clients, is you have to have a good formula for it. So there has to be a formula. Now, bearing in mind, you're not claiming this back from anybody. If you're self-employed, this isn't like a grant you can get back from the government. This isn't money they're going to pay back to you, like your phone bill from an employer or something. This is money that you can use to put into your profit and loss account, which will reduce your net profit, which then ultimately reduces your tax bill. So this isn't like cash back for anything. There's no grant payment for this. But the way to work out your working from home expenses, and there's a list of all this stuff. I think I might have put it on the blog. If not, maybe
you did. It was on the blog. Yeah.
There we are. So I've done a blog about this. But yeah, it's to look at all the relevant expenses you can claim, and then have a workable formula for it. So the one that we tend to use is the amount of time that you spend, how many rooms are in your house, excluding kitchens and bathrooms. So because for some reason kitchens don't count as a workspace. I don't know how that works if you're a video chef, but whatever. Kitchens and bathrooms, excluding kitchens and bathrooms or non-workable rooms. How many rooms are there in your house that are not those? And then you take the total of all the things that you've added up. So things like mortgage interest can actually go on there, light, heat, broadband, all that kind of stuff. And you add all that together, you divide that by the number of rooms that potentially could be a working room in your house, and then you times that by the percentage that you use that room as a business-based room. We always say never claim it 100%, just because it's a bit of a, there are some horror stories, they're anecdotal, but people claiming I only ever use this room only ever for business purposes. Well, you don't, there's not a wardrobe in there with some clothes in it, there's not some other stuff in there, you haven't got a storage box in the corner. HMRC never like 100% use of anything, so we always say a high percentage if you're at home all the time is absolutely fine, and that's how you work that out. But remember that this isn't expenses getting repaid. This isn't money back from the government. This is just a way of, it's another expense that you could legitimately put into your profit and loss account to reduce your net profit, which in then return reduces your tax bill. But yeah, I think that I did put the full list of what you can claim over on the Connektd blog.
Cool. Do you have any more questions there that have been sent in privately that I can't see?
I'm just having a little look now. Not that I haven't been covered, I don't think.
I've got one here.
Oh yeah.
Which was it was from Deborah, and she asked a question earlier about universal credit and savings and things. If she's got a limited company and pays herself dividends, would she need to close the company down before she's able to apply for universal credit?
No, don't think so. But this is, so dividends is obviously investment income, and it is counted as income and does count when you apply for universal credit. So the company can still exist even if it's stopped paying you dividends. That company can still absolutely exist. However, if you're still receiving dividends for your company, so if you've still got a retained profit and cash in the bank account that you can take out as dividends, remembering again, this is to do with, so company savings and company cash balances are not the same as your personal savings. So that's like legal separation between limited companies and an individual. However, if your company is still paying you dividends and you're receiving that income or is making payments to you, then strictly speaking, that might mean that you're not eligible for for the universal credits. But it's a very individual thing. What I would say is it's always worth looking. But as far as I'm aware, you don't need to have closed your limited company down in order to claim for universal credit.
Okay, I've got one question here, which is an interesting one from Ajay, who I know is more complicated by the fact that he's not in the UK at the moment. But if you, particularly for people who've been set up with a limited company by their accountant and not necessarily understood exactly what that means, you've got your personal tax account and you've also got your limited company tax accounts, and the dates don't necessarily match.
Nope.
And you get different requirements and different calls for paying various different things at different times. Is there a way to actually get those aligned, or are they fixed the way they are?
No, you can absolutely align them. So again, this is the complication with the way that limited companies are set up in the UK. So the personal tax year runs from the 6th of April to the 5th of April every year. And the corporation tax year runs from the 1st of April to the 31st of March every year. Now, I wouldn't say it's worth adjusting any tax year or year-end accounts outside of this corporation, the tax years, because it's such a small amount of time. It's a few days. So they're basically aligned for all intents and purposes. Where it does get complicated is your limited company year-end can be, say, the 30th of September, but then you're submitting your personal tax return that's to the 5th of April. And that's where people kind of come unstuck. You can, if people like to have things more kind of, April to March kind of mentality, give or take those few days for the personal tax year overlap, you can change your company year end to be the end of March. So that would mean either shortening or extending one of your company financial years. Probably shortening is easier in terms of filing stuff, just as an FYI. You're not allowed to file for over 18 months in one go in terms of things like company's house and corporation tax, but you can file for less than that. So shortening a tax year or shortening a company year can be done if you don't need to you don't have to worry too much about comparative columns or comparative years in the accounts and things like that. Company's house rule is you can't change your company year end more than once every 5 years. So make sure that you've considered that if you're going to do it. But we have a lot of clients who, in order just to keep it all a bit easier in their head, will change their company year end to the 31st of March and then basically run everything at April to April, if you like, because it just makes a bit more sense to do that. Our company year ends the end of March because it makes sense to me that we're in line with tax years. The challenge there as well, if you've got a company year end that is, say, October, and the government changed the rate of corporation tax from different accounting years, you can end up paying two different rates of corporation tax within the same set of accounts or returns. So that can sometimes be quite confusing too. So if you wanted to make life simple, you can change your company year end. The way to do that is to do it at company's house. Sometimes it automatically feeds through to HMRC, but you can also just update them to let them know that your company year end has changed, so you don't get letters telling you that you need to file things when you don't. And then the same rules and deadlines apply. It doesn't also mean that the date that your confirmation statement at Company's House is due is going to change. Your confirmation statement isn't anything to do with your accounts and tax. It's a declaration of the stakeholders in your company that you pay, I think it's £13 every year to file for the privilege of having your information at Company's House. That date may not change, and you need to be quite careful on your filing dates because it's usually 9 months and a day to file, or 9 months for Company's House to get your accounts filed. But if you change the end of the year, it doesn't mean that you get extra time to file. Usually they keep that date the same the first time round. So just be a little bit careful around the dates. But yeah, it can absolutely be done. And sometimes it makes life easier for people in terms of just getting it square in their heads. It's sometimes a bit easier to get through. I like it. You also get people who run their years with a calendar year to 31st of December. Because it's easier to kind of get your head around. In fact, those are the two most common company year ends, the 31st of December and 31st of March.
Cool, thank you. That's very comprehensive. We've got a question from Ajay Mistry, who I know is from Create Insurance, actually. And we have to bear in mind that Lucy's on this call as an accountant, not a financial advisor. So do you have any advice to start planning now for next year's tax return? Any top tips to share?
Yeah, so keep on top of your accounts now, basically. Forewarned is forearmed, essentially. So use an accountant who does your books regularly and who doesn't just leave you to fill out stuff in QuickBooks or Xero or something and then checks it once a year. Nowadays, that's just not going to cut it. You need an accountant who's engaged with you on a more regular basis. They don't have to be expensive, but you need someone who's going to give you realistic tax projections through the year. We always say save the money. When you get your monthly accounts that have been prepared by an accountant, look at what they're projecting your tax bill is going to be and stick that money aside in a separate bank account. If you end up not spending it on your tax bill, great, that's a bonus for you. But if you need it, at least it's there. That's my number one tip, is to not spend money that you're going to have to one day eventually pay in tax. Kind of going back to the government support on the schemes here, we've got there's an automatic, you could take an automatic deferral of your VAT payment for a quarter, and you could the payments on account for self-employed people for July have automatically been deferred. The key word there is deferred. They haven't been cancelled, they've been deferred. You will still have to pay that money. All that's doing is giving a bit of grace and a little bit of leeway. My other top tip for tax, that's hard to say, is that you can, if you're struggling with a tax bill, so a lot of people will have a tax bill due very soon, and they have been hit with this, and suddenly they've had to use their cash reserves to keep their businesses running. You can use the HMRC time to pay scheme, and that's actually really good. Again, it's the thing, your accountant can't apply for time to pay for you. That's another thing that you have to go and do yourself. But you can ring up, there's a special coronavirus time to pay hotline, and you can ring it up and negotiate a repayment period for any tax bills that have come up that you can't pay right now. But yeah, with this kind of stuff, my advice is always don't bury your head in the sand. Your accounts and taxes have to be done. It is much better that you know where you're at throughout the year, so that when the year end comes, it's like, oh yeah, well I was expecting that, instead of kind of being like, oh no, I didn't think I'd have that big a tax bill, how am I going to pay it? You need to work with advisors and accountants and people who are going to help you understand your figures, help you understand your legal setup, and make sure that you know what's coming around the corner, rather than just doing the kind of old school traditional relationship, which is walking into an accountant's once a year and handing over a file of stuff and being done with it. I mean, we can't currently walk in anywhere without social distancing and hand anything over without disinfecting it. So yeah, go for someone who can service you remotely, and who at the minimum will give you advice quarterly. You know, that's the minimum you need, is quarterly updates on where you're going to be. I see it as part of your responsibility as a business owner. You made the decision to run a business, you have, and no one likes doing it, but you have a responsibility to be on top of this stuff, because it's so much better to be on top of it than not, basically. It just makes life a lot easier.
Okay, thanks, Lucy. I think that's all the questions I've got here, unless you've got any others there.
I don't think so, not at the moment. Nope, that's it for now.
Okay, well, this might be an opportunity for you to just take 30 seconds to explain what Mazuma Money is, so that people know, and what you do.
Sure, yeah. Thanks, Steve. Yeah, so Mazuma, we're proud to be partnering with Connektd. We were first to market in the UK in 2006 with a subscription-based accounting service, and we work with only small and micro businesses all across the UK. We're now one of the UK's largest providers of that. So in terms of what we do, we've got a huge, we work with a lot of people in the creative industries, in the events industries, film and TV, and we've got a huge kind of knowledge base of that work, and we understand those businesses. And I was talking about being on top of your accounts. That's what we're all about. Is we know that running a business is a burden in itself, and we don't burden our clients with forcing them to use any piece of software or spreadsheet or anything like that. You've got two options to get your information to us. You can either upload it into our app, snap and send, and then we'll handle all bookkeeping, reporting, and the rest of it for you. Or you can, if you're a bit more old school, you can stick it into a free post envelope and send it to us, and we will digitize and deal with all of your accounts and tax returns from there. So yeah, our mission is to solve the problem of accountancy for small businesses with an envelope, whether that's physical or virtual. But that's what we do. And it's all subscription based. So if you like Spotify, if you don't use it, you can just cancel your subscription, and that's that.
Cool. Well, thanks, Lucy. I think it's been really useful. Hopefully everyone's got the answers that they need and the information they need. If you do have any questions once we've finished, then feel free to send them to me at steve@getconnektd.com, and I'll forward them on to Lucy, and then she'll come back to you directly. We do have another one of these webinars in 2 weeks on the 9th of June with Create Insurance. That's at 2 p.m. We'll be putting those on our Facebook page and Twitter and everywhere, so you'll see the details for those and be able to sign up. If you've got any feedback on this, if it was useful, if it wasn't, if you liked it, if you didn't, drop me an email, let me know, because we're keen to make them better if we can. Otherwise, have a good day and have a good week, and I'll see you soon, I hope. Bye.